This video is going to talk about the order of the journal entries when you're talking about adjusting journal entries. Because on deferrals, take a look at what I've put on the screen here. These are also known as prepaid expenses and unearned revenues. They're called deferrals because you are deferring the expense or you are deferring the revenue. In other words, you're holding off and not putting it into an expense until you've used it up, or you're holding off and not calling it a revenue until you've earned it. So they're called deferrals. And they come about because cash changed hands. That means we received the cash or we paid the cash, but it wasn't time to recognize the associated revenue or expense. So in a deferral, the very first entry that happens is not your adjusting journal entry because it involves cash. It is what starts the deferral. So here, we received cash, and we're going to place it into the liability saying that we owe them the work. And then once we have done the work, that becomes our adjusting journal entry. Later on, when we realize that we've done the work, we're going to take it out of the liability and show it into fees earned because we've done the work. So the second section is actually your adjusting journal entry. So here's your deferral when we got the money, when we deferred it. And here's your adjusting journal entry when we start to earn the revenue and recognize the revenue. Let's look at the next one, prepaid insurance. So we've paid up front for insurance coverage. So we've deferred our insurance expense and we've held it in this asset. Okay, so that's your deferral, and it's a regular journal entry because it includes cash. But at the end of the month, when we realize that we've used up a month's worth of insurance, then we're going to move it into the expense and take it out of prepaid insurance. So that's your adjusting journal entry. Let's look at supplies, which is also a prepaid asset. The first entry is where we defer the supplies expense because we don't need supplies expense yet. We're going to place it in the asset, the prepaid asset. And then later at the end of the month, when we realize that we've used up some of our supplies, then we're going to have supplies expense and supplies. So this is your adjusting journal entry. So again, this is your deferred regular journal entry where you defer it. Your adjusting journal entry happens when you go to undo the deferral. So that's deferrals. Let's look at accruals. And I made a little note here. All unearned liabilities eventually become revenues, and all prepaid expenses eventually become expenses. All right, accruals. This is where we have earned the revenue, but we didn't receive the money yet, or we have incurred an expense, but we have not yet paid for it. So the first journal entry is your adjusting journal entry. Notice it doesn't have any cash. This is your adjusting journal entry. We debit accounts receivable and we credit fees earned because we did the work, but we just haven't gotten paid yet. The second journal entry happens, and it's your regular journal entry, when we actually get the money. We get cash and we reduce our accounts receivable once we got it. Let's look at an accrued expense. So our employees have worked, but we haven't paid them yet. So we have salary expense and salary payable saying that we owe them. And then later on when we go ahead and pay them, we'll reduce the salary payable and pay out the cash. So what you'll notice about the order here is that for an accrual, your first entry is your adjusting journal entry. But for a deferral, your second entry is your adjusting journal entry. And lastly, the point I want to make is that oftentimes your textbook question will be asking you for just a piece of this, usually the adjusting journal entry part. It'll ask you for this part, or for the accrual, just this part. But it helps to know where we start and where we end with all of these journal entries.